first of all, I wouldn't want you to think about anything at all now except what I'm teaching you. So whatever that you've learned, I don't want you to throw it away. I just want you to keep it aside. What I will talk about here is directly correlated to whatever that you've learned since this boot camp started, or whatever that you already know in the market. Just that I would want you to focus here and then listen to what I say very, very carefully. All right, so I hope I'm being heard right. Please, am I being heard?
Loud and clear, Baba.
All right. So first of all, we will talk about fair value gaps, and I hope most of you guys here know fair value gaps. But if you are not familiar with fair value gaps, you see fair value gaps, they are gaps within price, okay, indicating imbalance. So fair value gaps, they are a three candle pattern, right? Whereby we have the first candle, a second candle, which is a displacement candle, or one would say a strong candle. So if it's a strong bearish candle or a strong bullish candle, but then the first candle is always, any type of candle out there. It can be any candle that you want. But then the second candle, that is the candle that actually creates the fair value gap. It's a displacement candle. That means it displaces. That means it's a faster candle. It's a stronger candle that actually creates the gap between price. And then the third candle, that is a consolidation candle. So the first candle can do anything that you want, right? The second candle can be it should be a displacement candle, right? And then the third candle should also be a consolidation candle, or it can be a candle that is moving away from displacement candle. That means it will be another strong candle, right? But then the fact that there is a gap between the first candle and the third candle that was being created, that gap is what we call a fair value gap, and it's indicating imbalance, right? Imbalance in the market orders, showing that one side has been inefficiently offered, and so basically the price has to be balanced, right? That's why we call it imbalance, because it has created imbalance in price. So that means it has to be balanced. So price has to be balanced because the market can't be one-sided. So when we give a fair value to the buyers, we have to give a fair value to the sellers too. That is the whole idea of fair value gaps, right? Now, before we actually move into liquidity sweeps, I want to talk about drawn liquidity. So I hope everybody gets the idea of fair value gaps, right? So we have drawn liquidity. And so when we say drawn liquidity, okay, to arrive at a drawn liquidity consistently, we must first understand that price is only doing one of two things, okay? So price is doing two things. Either price is seeking liquidity or offering fair value, okay? Price is either seeking liquidity or offering fair value. So if price is not offering fair value, then it's seeking liquidity. If price is not seeking liquidity, then it's offering fair value. So anytime that you see a fair value gap, okay, is everything all right?
Yeah, loud and clear.
All right. So anytime that price is offering fair value, when it has done offering the fair value, and that means when price has come into the fair value gap, please don't get it twisted. I'll explain everything. I'm just trying to explain the drawn liquidity to you. When price has offered the fair value, the next option or the next destination for price is seeking liquidity. Okay, and when I say liquidity, um, liquidity can be found at the highs and lows of the charts, right? The candles, right? So any high or low that you see, especially a swing point. When I say a swing point, um, let's take this ERL for example. Right? This is external range liquidity, right? So this candle right here, right, is a swing high, right? So we have a high to the left and a high to the right, and you have the highest high of it, and that makes it a swing high. Okay, and so before price taps into the fair value gap from that high or from that low, okay, in this example, we're using this high. So from this high into this fair value gap, from that high to the fair value gap, that high that was created right there is what we call the draw on liquidity. And in this context, it's our external range liquidity. Okay. And so the fair value gap that I first explained becomes what? The the internal range liquidity. And I'll explain this further again. So price will move from the internal to the external, and then this idea is across either we are trading. I call this I call those who trade the candlestick patterns traditional traders, right? Either you are trading traditionally or you are trading smart money concept as in SMC, SLK, LCLE, whatever E, whatever SL, stop loss. um and then ICT, what you know is that price moves when price goes down, it definitely has to come up, right? So when price moves to the external, it has to come to the internal, and then it moves to the external again, it comes to the internal. We'll go on to the chart, I will explain this. Okay. So the whole idea here that I'm trying to paint to you is that for the single fact, okay, for the single fact that we know that when price enters a fair value gap, okay, in the right market structure. So when we are in an uptrend and then a fair value gap is created, when price gets into that fair value gap, what we are expecting is that it should support price, or if it's a resistance, it should resist price, push price lower or push price higher to the external range liquidity or to the high before the fair value gap will start. So I'll go on to the chart and I'm going to show you exactly what I actually mean. All right. Okay. So please, do you see the trading view chat? Uh, Oseo Brimpon, please help me here. Can you see my chat? Can you see my trading view?
Yeah, I can see it. People are reacting. That's why.
Oh, I can't actually see
Yeah,
the
my
reaction.
network,
I'm at full screen,
my
so I can't
network no
actually
good,
see.
so I don't really see it.
I'm seeing
Oh.
it. I'm seeing it. Don't worry.
Yeah, yeah, I can see it trading view.
All right, so let's draw a simple market structure, right? That you already know. So this is an uptrend, right? Good. So we create higher highs and higher lows. Good. So basically, I mean, practically, everyone knows this. Everyone who is a trader, either you are a beginner or you are a pro trader or you are intermediate or you are whatever, you know this simple market structure. So the whole idea is that when price gets to this level, when price makes a higher high like this, it has to make a higher low if it's in an uptrend, right? And so when it makes another higher high, we are expecting what? A higher low, and then and so forth, right? So good. So this will be the external range liquidity that I'm talking about, right? External range liquidity (ERL), and then did I actually type ERL? Okay, good. So the highs, okay, the higher highs is or are the external range liquidities, okay? And then when price comes or when price retraces, this is called a retracement, right? So we have momentum, we have let's say a bullish momentum, right? So we have a bullish uptrend right there. You have a retracement, right? And you go up again, you have a retracement again, you go up again, right? So the retracement, where is price exactly retracing to? Okay, and then you're not trying to actually predict, right? You're not actually trying to predict where price is actually retracing to. What you are trying to do is that find fair value gaps in this specific leg right here, or this specific leg right here. We are trying to find the fair value gap in it. And when you find that fair value gap, that is what we call your internal range liquidity. Okay, that is what is your internal range liquidity. So what you're looking for is for price to come back.
Morrison.
All right, I'm listening.
So if I got you right, we are seeking for internal range liquidity from the impulsive and retracement move the market is making.
Uh, mm, well, what I'm trying to do here is explain um, basic market structure, right? How price moves, right? Using fair
Hmm.
value gaps, right? So
Yeah.
when there's an uptrend, right, and price is retracing, what we are looking for is a fair value gap within that particular um leg, okay, that broke structure, especially let's say this leg, right? I don't know how to call it. That's why I'm calling it leg. So bear with me. So this uptrend right here, this shaking my head. This trend right here that broke this structure, okay. When
Yeah.
price retraces back into it, okay, we are looking for a fair value gap within that specific leg, that broke structure, okay, and that is what we are expecting to hold price and push price higher, right?
Mm.
So let's say there's a fair value gap here, right? And when price is coming back to it, this is what we expect price to do. Price will just come back to it like this and then move upwards. This is our expectation. So when price comes into it like this, when price comes down into the fair value gap like this, from that high, okay, that made or that started the retracement. From this high, that started the retracement. That is your higher high. That made price enter the fair value gap. That high is what you call your external range what liquidity,
Liquidity.
and that is your drawing liquidity. When you say drawing liquidity, where price is moving to next, the objective of price. So be- uh, because because I want to make this simple, that is why I already told you that you need to actually know what the trend is, and that's why I drew an uptrend to you to explain to you that when the price is an uptrend, what you're looking for is a fair value gap. Price taps into fair value gap. You are looking for your entry model. This is the basic idea. An uptrend, the retracement, you are looking for a fair value gap. Price enters the fair value gap, then goes back to that high that created the retracement, that high that got broken, right? So this high is expected to be broken because it's an uptrend. So when price retraces into the fair value gap like this, we expect this high to be broken. And so in doing so, you trade from the fair value gap to that external range liquidity, and that is your draw liquidity because when price has done offering fair value in the fair value gap, it means that it has been balanced. Okay, it means that the price has been balanced. Now it has to move to another objective, and that is the external range liquidity. So we have the internal range liquidity being the fair value gap, and the external range liquidity being what? Being the higher highs or the higher lows. So an example in a downtrend is going to be also like this. Mm, good. And so we would have good, good. When you get to understand this particular idea that I'm teaching you, right? When you get to understand it, you would realize that this is actually so simple. Just fair value gaps and then higher highs or higher lows. All right. And then so this is the external range liquidity. And also this is the external range liquidity. And then you have the internal range liquidity. That is what the fair value gap that is your internal range liquidity. Mm. Because um I hope everything is clear, right? How do I get to make everything is clear? I hope everyone is okay. Please, if you're okay, just give me a thumbs up or something that would actually let me know that I'm actually doing what's right. All right. So before I actually get into the entry model, okay.
Um, Morrison, hold on.
All right.
Emmanuel J is giving a thumbs down, so I'll take it as he doesn't get it. And Kwame
Okay.
Ofori's hand is also up. And so, Kwame, if you have a question, I know you just joined. I know if you were trying to send a reaction that resulted in putting your hand up, but then let's have it. If you okay, Adanse's hand is also up. So then let's take a question from Adanse before we continue. Adanse, you can unmute and
Uh,
talk to us.
please, I want him to go over again.
Okay.
Ooh.
Um,
Not all, but the
the
drawings.
sell side
Yeah,
for the sell side.
yeah,
Okay,
for the
sir.
drawings. Yeah.
All right. Oh, I mean this is simple, so I can explain this again.
Um,
All right. So
Emmanuel Che is Emmanuel okay? Emmanuel Che, do you have a question to Emmanuel? Are we good, or I have a question to so that he can address them together and we'll move faster? Emmanuel Che, do we have a question? Are we good?
Oh no, please, I don't have anything.
Okay. Then Morris, I think you can continue now.
all right. All right. So the whole idea is about fair value gaps, and in layman's terms, higher highs or lower lows. Okay, so this is layman terms, higher highs or lower lows. So higher highs like this, okay, the one that I've denoted as ERL, right? That is the higher high. So in a basic market structure, we have higher highs and we have higher lows, right?
Mm-hmm.
And then we have lower lows and we have what lower highs. Okay, so the lower lows are the ones that I've also denoted as ERL. So don't get confused. ERL can be either in an uptrend or in a downtrend. Okay, so the IRL fair value gaps. Okay, the fair value gap that I had already explained to you guys. Okay, in the first presentation. So what I'm trying to tell you is that the whole idea of this model, this entry, is that you should know the basic market structure where the trend is actually moving to. So if it's an uptrend, you should know that this is an uptrend. If it's a downtrend, you should know that this is also a downtrend, right? And then also we have our fair value gaps. So we are trading between the external range liquidity and the internal range liquidity. So when the price comes into the internal range liquidity, that is the fair value gap. Okay, so I'll stop mentioning
Mm-hmm.
internal range liquidity and I'll use fair value gaps so you don't get confused. So when price comes to the fair value gap, we are expecting price to move to the external range liquidity. That is the higher high. Because in an uptrend, you expect the highs to be broken and the lows to be what? Protected. Okay, you expect the highs to be
Mm,
broken, lows to be protected. So the lows that are being protected, no, they are what are initiating or starting the price or pushing the price to move to break
oh yeah.
the um the higher
Mm,
highs, right? Or the lower lows if it's in the downtrend.
mm-hmm.
So the highs and the lows that we are talking about here is our draw on liquidity. That is our external range liquidity. And I say draw on liquidity is just a name, right? Practically or basically, it means that where price is heading towards. That is a draw on liquidity, right? So I hope this is clear now. This is clear now.
Morrison, I want you to
Yes.
just I want you to so what you're saying, you're saying that price moves from internal range liquidity existing at let's say higher highs for the buy channel. Price moves from internal range liquidity in the form of fair value gaps existing at higher lows and moves to external range liquidity that exists at higher highs. Is that correct?
not not how I actually so all right then not how I actually want you to understand it. So I would go over again
Okay.
one more time. Okay.
Mm,
So starting again, let me delete all these. Starting again, right?
okay.
How do you guys select everything and then delete? Uh okay. Uh-huh. Sorry guys, sorry.
Backspace. Everything will clear. You just select backspace, you're out.
Backspace.
Yeah, you select what you want to delete and backspace. So clear it.
I thought you could actually delete everything
Now I will
like
clear everything on your chart too.
everything here too.
Your main chart, if you use what you want, if you want everything will go, like everything on your main chart will go. So you just use the
Anyways,
back.
I'm actually done. So,
That
all
one will
right.
help.
So, I hope this time everyone understands this basic market structure: a downtrend, uptrend, right? So, this is an example of an uptrend. Price moving higher, right, to create a higher high, right,
Mm-hmm.
and then moves lower to create what a higher low. And so, this high right here, we expect it to be broken because what price is actually creating higher prices, right? So this high that is supposed to be broken, since we are expecting price to move towards it, that is our draw on liquidity, and that is where price is heading towards because we are in an uptrend, right? So the high right here, okay. So when price creates another high, creates a low, right, and then it's moving towards the high. That is the drawn liquidity. That is where we expect price to move towards because it's creating it's creating higher price, right? Good. Now we will come to these lows that are the retracements. And what I'm trying to tell you here is that this specific let's say this specific movement right here is a bullish momentum, right? That it's a bullish movement, multiple bullish candles that form this singular leg. That's how I'll mention it. I'll call it leg for it to be easy. This singular leg. Now this singular leg right here, it did what? It broke a higher high, indicating what? An uptrend, indicating higher prices. Now, when the market is moving upwards, it doesn't just move upwards and then it doesn't stop. Basically or practically, it has to come down, right? It has to come lower for lower prices and then move higher again because when price goes down, anything that goes up has to come down. That's the whole idea. Anything that goes up has to come down. And we are trying to tell you here is that when price is coming down, okay, when price is coming down, we are expecting price to get to a fair value gap in the leg, okay, that broke the structure. Okay, so this particular leg right here, forget about it breaking structure even. This particular leg right here, we are expecting there to be a fair value gap inside of it that is going to support price and then move the price higher. So when the price goes up like this, we are expecting price to come back to that fair value gap. And then the fair value gap is going to support price and move it higher, right?
Okay,
So
Morris,
that's
so I think it is with how you drew it the first time. It now makes sense. It now makes sense per the explanation you just gave. I think it was from the drawing from the previous one. But with
all
this,
right.
it actually makes sense now. I actually get it now.
And that's
But
the
then
same. Vice. Mhm, mhm.
Imanoche is also asking what time frames should we check the fair value gaps from?
I'll get to there, right? I mean, I'm
Okay,
actually
sir.
I'm actually spending more time here. I don't really like it, right? So I'll get to where the time frames and everything, right? This is like the basic idea. That's why I need you guys to understand this. When you get to understand this, the rest are just entries, time frames that you can actually put in your head that you have to go to this time frame and go into this time frame, right? Good.
Mm,
And then same applies to a downtrend too. So when price moves up, right? When price moves up, creating a lower high, we expect it to do what? Break this lower low and then create a new lower high, right? So in this specific leg that broke the higher, the lower low, there's a fair value gap inside of it, and when there's a fair value gap inside of it, we expect price to retrace back into it, get to that fair value gap, get resisted, and then trade lower. Okay, and then what I'm trying to say again is that when price comes down like this, right? This low right here, this low right that I have my pointer on, from that low to the fair value gap that is supposed to resist price, that low right there is your target. Let me say target rather than draw liquid. That is your target. So when you trade from the fair value gap, you are expecting price to get to at least that target or even nearer. Or in case you have, your risk to reward ratio that you are using, price will get there and then do what? It will show lower for do what you expect it to do. I hope this is understandable, right?
Yeah, I now get to the meeting now.
And so please, if anyone is having a problem, they can let me know before I continue because I'm done with this side. So if you're okay, you just give me a thumbs up, and then if anyone if it's all right, I'll just continue.
Emmanuel Kwame got the. Okay, we've got 5 reactions on it, so I'm sure everyone is good. No questions in the in-call messages. New people
Okay.
have joined, so then I think we can go on.
All right.
Yeah.
So now I'm coming to give you the chat idea of what I was actually talking about,
Mm,
right?
yes, sir.
So let's use this downtrend for an example, right? This downtrend right here. This downtrend.
Mm,
Okay. This you see multiple candles, right? So you see
yeah.
um multiple bearish candles. So those are the red candles. And sorry. So we have a low like this, right? Then we have what? A high like this. We have a low like this. We have high right there. We have a low, right? So this is a downtrend. I mean, this is a 4 hour time frame. If you go into a lower time frame like 15 minutes or even 1 hour, you are going to actually see this properly. I don't want to go in there because we are going to actually use the 4 hour time frame. Okay. Now the
Mm,
idea, I just want you to take the idea, not the drawings. Okay. Don't take the drawings that I actually drew. Take the idea that when price moves from a fair value gap, it is going to the high or the low that made price enter the fair value gap. Okay. So in this downtrend right here, in this downtrend right here, we have a fair value gap that I've indicated right here. This is a fair value gap, right? Because we have first candle, second candle, and then what? A third candle. And as you can see, that the second candle is always a stronger candle. It should be a stronger candle because that is what is going to create the fair value gap. So this second candle right here, this second candle right here, the first candle, this is the first candle, this is the second candle, and this is the third candle. So between the first and the third candle is a fair value gap, right? So when the highs and the lows don't touch, when the low of the first candle and the high of the third candle, right? If they don't touch, right? If they don't cross, they create a gap, and that gap is what the second candle actually represents. So between them, there's a fair value gap. And then when price traded into that fair value gap right there, when price got into that fair value gap, so there is the idea. And when price entered the fair value gap, what did it do? It traded to the low, okay, the low right there. So let me delete this, right? And I've um denoted this as external ring liquidity right here. Good. So watch this carefully. When price entered, when price created the fair value gap right here in a downtrend, when price got back into the fair value gap, okay, when it got into the fair value gap, it traded to the low. So this low right here, okay, this low right here is what created what made price enter this fair value gap. So when you enter here, okay, when the fair value gap actually pushes price lower as expected, you expect price to do what? Come to this low. And please, this is not how we are going to trade. We are not just going to enter right from the fair value gap. No. But this is the idea. Okay. When price enters the fair value gap, you expect it to do what? Trade to that low or high that pushed price into the fair value gap, and that is your target. So you don't target any also places of liquidities, right? But when you have like example like this in a 4 hour time frame like this, when you go into the 15 minutes for your entry, right? It's a very long journey from the fair value gap to that low, right? So the drawings that I made, this is what I mean. Okay, the drawings that I made, this is what I mean. So in a downtrend that you've established that price is actually going down, or in an uptrend that you've established that price is actually moving upwards, when price is heading towards a fair value gap for retracement, okay, when price is heading towards a fair value gap for, so this is an uptrend too. And as you can see, we have a fair value gap right here. Have this first fair value gap, right, and have a second fair value gap right here. The first candle can do whatever it wants. The second candle, however, should be a displacement candle, a stronger candle. So jot it down. It's very, very important. There's a reason that I'm saying it, because when it's a displacement candle, it means that it's moving faster. It means that it doesn't want to stay there, right? So that's what we call displacement. We call it displacement by when when you splash a football into water, right? The water splashes and it displaces. All right, so let's focus on forest. And then so in that displacement, right? In that displacement is the second candle and the third candle. But as you can see in this layer, we have what? We have first candle, second candle, and then what? Third, first value gap, second fair value gap, and then a third fair value gap. But one will say, why didn't I choose any of these fair value gaps rather than this one? I didn't know, and I wouldn't lie that I knew that price would actually disrespect or not. So fair value gap, this fair value gap is not going to survive. I didn't know. What I knew is that I'm looking for a confirmation. So when price comes into this fair value gap, I'm not just going to trade blindly from the time frame that has the fair value gap. That is not what we are going to do. And that is not what my students are going to do. So if you are my students, you're not going to trade blindly from the fair value gap because price entered it and I said it's an uptrend, and when price enters the fair value gap, you expect it to move to the high. No, we don't do that here because we always need confirmations. I feel like I'm I didn't do that. This is everyone listening. Thumbs
Yeah,
up,
yeah,
thumbs up
yeah.
if you can hear.
I'm active. I'm
Yeah,
active. I'm
yeah.
learning.
All right, all right. This place is so quiet, so I felt like I was talking to. All right, so let's continue. So when price comes into the fair value gap, right, you expect it to want to move higher. So the reason I didn't use this fair value gap is that price never got there. So in case price had disrespected this fair value gap and then come into this fair value gap, right, I would be looking for my confirmation or my entry model in that fair value gap too. But unfortunately or fortunately, price never came into that fair value gap, but rather came into the fair value gap and reacted from it, right? So how am I going to know that this fair value gap is going to work? What as first I told you, I don't know. So you just mark your fair value gaps. That is the first thing that you do. Just go into your time frame, right? So here's the time frame, and you need to jot this down, right? We are using the 4 hour time frame and the 15 minutes time frame. Now, the 4 hour time frame is for your structure. The 4 hour time frame is to determine where the market is moving to. The 4 hour time frame is for your bias. It's for where the market is moving to. That is what you are going to use your 4 hour time frame for. Nothing more, nothing less. Fair value gaps. If it's an uptrend, you're looking for an uptrend. You're looking for the fair value gaps in the uptrend. If it's a downtrend, you're looking for fair value gaps in the downtrend, and that is it. That is the only thing that you are looking for in the 4 hour time frame. So we are using two time frames. We are using the 4 hour time frame. We are using the 15 minutes time frame. Okay. And please pardon me if you start hearing noises. There's this church behind my house that on Mondays in evening like this, they decided to actually do one of the most irritative things ever because fine and air all night Monday. Please, I'm sorry, okay. Now me ask them the air, but I just say that we did go soon too much every Monday. Meanwhile, Sunday, more yeah, sorry. So okay, so so let's continue. So the 4 hour is for your structure, is for your fair value gap. So in the 4 hour is where you're finding the fair value gap. So as I already mentioned, right, this is your uptrend. So this is very, very easy for you to identify, right? So this is the uptrend. Price moving upwards like this. Okay. And then this is the retracement, right? So the retracement is into the fair value gap. So when price got into the fair value gap, it did what? It moved to the high that caused the retracement. So that high is your target, and that is why I've named it the ERL as the external range liquidity. So the fair value gap is the internal range liquidity, right? So first of all, I'm really sorry that I didn't write this down. So first of all, you are looking for your 4 hour structure, either a downtrend or what? A downtrend or an uptrend, right? And then the next thing that you are looking for is fair value gaps in that structure. So if we are in an uptrend, we are looking for fair value gaps in that uptrend leg, not a retracement, not the retracement, not this one, rather this one. So if it's an uptrend, we are looking for what? A fair value gap in the uptrend leg, right? So on the 4 hour, that's what you are doing. So you just note this down. These are just simple points. 4 hour structure, either uptrend or downtrend. Number two, you mark your fair value gap. So you come here, you mark every fair value gap that you see, right? Every fair value gap that you see right here. You just mark them. You just mark them for the fun of it, not going to trade from it, and just see how price reacts from it. Just so whatever that I'm saying here, don't just take it at hindsight. You can actually go into the market and look at how price reacts to fair value gaps, and especially the right fair value gaps. Okay. So now, if everyone is okay with how I've explained the structure with the 4 hour fair value gap, please let me know so I can continue to the main thing, that is the entry model. That's like the most important one here. Thumbs up, please. Then you don't have to talk. Just give me thumbs up. I have 3 times up. It's not enough. 4. Okay. Let me see. All right. So I guess everyone actually gets what I'm trying to say here. Good. So now the entry model. The entry model. The entry model. That's like the famous entry model. The famous ICT entry model. All right. So whatever that I said here is just lame. Everyone knows this. Right? SMT traders know this. ICT traders know this. Even basic, not basic, traditional traders also knows this. But then let's get to the entry model. And even entry model, SMT traders also are, quite familiar with it too. So we'll get back to the presentation again. All right. So this is your entry model. Okay. And then I'll send this PDF to my man, and then he will put it in his resource group or wherever that you guys will be able to access it, right? So the higher time frame PD array is the 4 hour fair value gap that I'm talking about, right? Please, there are some things that I would want you to ignore here, especially something called the kill zone. Okay, I wouldn't want to confuse you so much, so let's just get on with the idea of the the fair value gap and the entries. All right. So with the entry, we'll be doing our entries, okay, or we'll be entering the market, or we'll be looking for the confirmations the confirmation. So this is your model. This model is called the ICT 2022 model. Now, the ICT 2022, the main model actually uses highs and lows instead of fair value gap. But then I decided to create, my own strategy with what I've learned from, ICT, and then use this entry model, read the fair value gaps rather, right? So what we are saying here is that once you have identified your fair value gap, okay, once you have identified your fair value gap, that you are waiting for price to retrace into it, frame PDRA, HTF PDRA. And we say PDRA means premium discount array. I hope you guys have talked about premium and discounts in your previous here as a fair value gap. Think of this rectangle here as a fair value gap. Now we are in an uptrend, right? We are in an uptrend. Okay, we are in an uptrend, and then this is the fair value gap right there. This is your fair value gap that you are waiting for price to do what? Retrace into it and then move higher. So now you understand that when price doesn't do any of these, that what I would explain, you don't have an entry. That's why I tell you that don't just straight on the 4 hour. Look for the fair value gaps on the 4 hour, and then come into the 15 minutes. 15 minutes, not 5 minutes, not 1 minute, not 30 minutes, not 10 minutes, 15 minutes. It's 4 hour and then 15. Time frame alignment 4 hour, 15, 1 hour, 5 minutes. These are for exclusive students, so I can't share more than that. So it rests everywhere too. So it's not just about, this is practically the best one actually. If you want to scalp, that's why you use the lower time frame ones. So the 4 hour fair value gap is the higher time frame PDRA. And then you go into your 15 minutes. So when you enter the 15 minutes time frame, we're looking for 3 things. 3. 1, 2, 3. First, we're looking for a sweep. And I just said a sweep, right? And I just have to ask if everyone is aware of what a sweep is before I also continue, because if you don't know what a sweep is, it's going to be actually a hard task for you to understand this. But please, if you know what a sweep is, right? If you know what a sweep is, just give me a thumbs up. Like a sweep of liquidity. Sweep of liquidity. Anyone? All right. Sweep of liquidity. All right. So I think I just need some. I thought someone was talking. Judah, please can you unmute and then.
I'm sure it's reverberation in the background. I didn't hear anybody talk. I'm just sure.
Oh, okay.
I'm sure. Yeah.
All right. So I guess no one is actually disputing the fact that I won't take favorably the cheapness. So that means that I can actually continue, because I think it's Morris, right? Morris last week or so, he did the sweep and then the break of structure and then the other blockchain. So I think you guys actually have the idea of what a sweep is. So let's just continue. Easy. All right. So you are waiting for a sweep into the fair value gap. So when you go into the 15 minutes time frame, the first thing that you are looking for is a sweep either inside the fair value gap. So this S right here, this horizontal line, is it horizontal or vertical? This horizontal line with the S, right, is the sweep. So you are looking for a low that price sweeps into the fair value gap. So it's either price sweeps into the fair value gap or price sweeps inside the fair value gap. Please listen carefully. Price needs to create a low prior to the fair value gap or inside the fair value gap and sweep it. Okay, so this is a chart example. Price needs, I've indicated this as sell size liquidity. Okay, it's been indicated as as so price need to sweep. Okay, so price, let's say there's a higher time frame period that is somewhere around here, right? Price needs to sweep the liquidity. So price needs to go below that low. So we have what, and this is a downtrend. So we have a low, right? Follow the pointer. They have a low, a high, a low, a high, and what? A low, okay, a high, and then a low right there, right below this low. See, it got rigged out, okay, but it's still a low, made a high, and another low right here. So we have a downtrend. So this was the last low. Okay, this was the last significant low. That price swept or price went below. So basically, we would say this is a break of structure, right? We say this is a break of structure. So let's say the last low that price broke structure before entering the fair value gap. Okay, before entering the fair value gap, that is the low that you are looking for. You are looking for the first thing, a sweep, and you are looking for number two. Number two is a displacement. Okay, so don't look at the numbering here. Okay, listen to what I'm saying, and then I'll give you this chart too. Everything that I'm saying will be correlated to what's on the charts too, so you wouldn't actually get confused. But for now, listen to what I'm saying. This is like back in the teachers where we tell you to close the textbook and listen to the teacher rather, right? So a sweep into the fair value gap or a sweep inside the fair value gap. Please, this is very, very important to me. The sweep should happen either prior to the fair value gap or inside the fair value gap. And I've mentioned this multiple times because it's very, very important. I've made mistakes whereby I used a sweep that wasn't prior to it, and I mean a sweep that had, a low that isn't even near to the current structure. The low should be in the current structure. The low should be in this current structure, not some structure far there, right? Should be prior to the fair value gap. Price enters, we're looking for a market structure shift with displacement. So since I've already explained what displacement is with the fair value gaps, we are looking for a displacement. So when price gets into the fair value gap, when price sweeps and gets into the fair value gap, we don't know yet that this is a sweep. In your head, it is a break of structure. The moment price breaks above the high, that's swept liquidity. The moment price goes above the high, that's swept liquidity. That is what you can tell a market structure shift or a change of character. Okay, because now price has changed from bearish to bullish. Price has changed from bearish to bullish. So, Kumasi means bullish. Why? So when price sweeps the low right here and then goes into and then goes into sorry, and then goes into the fair value gap, right? It's still a break of structure until price moves above the high right here. So when price goes below this, it's a break of structure, and then when it comes above it, this high right here that created the low, when price goes above it and it closes above it with displacement, listen to me very carefully. Displacement, and I say displacement, this was something that I mean. You see the first candle right here, the other pointer is on, and the second candle right here, this second candle right here that you are seeing is the displacement candle, right? And the third candle right there. So this is what we call a fair value gap, right? Fair value gap right there in between. So you need a displacement. So first, a sweep prior or inside the fair value gap. Okay, so a sweep prior to the fair value gap or inside the fair value gap. A market structure shift with displacement. A market structure shift with displacement, and then a fair value gap. So when a displacement is made, when there's a displacement, we always have a fair value gap, because when there is displacement, there is imbalance. This is what we are looking for. So we are looking for a sweep. Once again, number one, we are looking for a sweep into the fair value gap. We are looking for a break above the high or the low. This is an uptrend, right? We are going to create an uptrend right here. So this is a high, a break above the high. So a change of character, and I call it a market structure shift. Change of character. What? A market structure shift right here. So a change of a market structure shift is a change in trend. Okay, so that low right here, that high right here, that went below, and the price goes above it with displacement, that creates a fair value gap, right? So displacement through the swing point. So displacement breaking, changing market structure, it creates a fair value gap, and then that fair value gap is where you are going to be entering from. So I'll go on to the chart and I'll show you, but for now I want you to get the idea. So you can even draw it. You can even just look at this, right, and then draw. If you are writing notes right now, just draw whatever that you see here. It's just a simple structure, right? We have a low here, a high, and the low gets broken, right? So it's a break of structure right here, enters the fair value gap, goes above the high that broke that structure. So in a downtrend, this high is supposed to be what? Protected, but now it gets broken, and that means it's a change of character, a market structure shift, goes above it, reach displacement, and so with the displacement, it. So the fair value gap that you see is where you are going to be entering from. Easy. So when price comes back into the fair value gap, you expect it to do what? Move price higher. And with this one, you do it with confidence. Please, you take stop loss. Of course, you always take losses. But with this one, you do it with confidence because you have almost everything confirmed. You have your structure. You are aware that we are in a 4-hour uptrend. Okay. You are aware that when you enter the 15 minutes, you got your sweep, you got your market structure shift, you got your fair value gap with displacement too. The reason the displacement is important is that when there's displacement, it means that the market doesn't want to stay there. That's why the displacement is important. And when I'm talking about it, I get so excited because the moment you see the fastness of price, it means that the price doesn't want to stay there. And that is what gives you the idea that the market wants to move what? Higher. But the moment it comes to the fair value gap, you just enter it. No two ways about it. So this is the entry model. This is the entry model, right? So I'll go on to the chart and I'll present to you what I actually mean from the chart's perspective. And then yeah, that will be all actually. When you get the entry model, then you are done. Okay. So charts. All right. Good. So let's start from gold. And please, this is applicable anywhere that you go. MTN. This is applicable anywhere. Indices, cryptocurrency, forex. When I say forex, I mean Euro USD, Euro JPY, the rest of the brothers. Anywhere, S&P, why? They all have fair value gaps, and so they all have this specific entry model. Good. So let's use this first fair value gap for example, and I pray that when I go into the 15 minutes time frame, it will not actually get missing because it's been a while. All right, so that was fast. All right. All right, so guys, bear with me. I'm coming. I'm looking for good. So this is the first fair value gap that I marked, right? So this is the 4-hour fair value gap. Okay, this is the 4-hour fair value gap. Now let's look at something right here. Now what I drew was just a demonstration. So now you are going to actually understand how the market actually acts, right? And when we're using this entry model, if you want to actually get the swing point correctly, the swing point, that is, the highs and the lows, that will be broken for you to know there's a market structure shift. There's this indicator that I will recommend to you, and the name is rick.ed fractals. Rick.ed fractals. And what this indicator does is that it indicates the swing points so that it will be easy to actually be spotted. Okay, you just spot it easily. So as you can see, there's this red dot on my candles, right? And this indicates that these are highs and lows in the structure, right? So this is a 15 minutes time frame. This specific fair value gap in the 15 minutes didn't really actually give you the textbook example of what I meant, but it still gave us what we meant. So now we have the fair value gap here. This is the high that created the fair value gap, right? This is the high, the high that created the retracement or started the retracement, entered the fair value gap. So now we have what? We have a high right there. We have a low right here. We have a high right here. We have a low right here. A high right here, what? And a low. Now the low is what entered the fair value gap. So what are we actually looking for? We are looking for what? A market strategy. We are looking for price to go below this high. Until price goes below this high, my brother, my sister, my uncle, my auntie, my mother, my dad, please, until price changes market structure, don't try to find a fair value gap in here. Don't do it. You're going to hurt yourself. Until price goes below this high right here, that actually created the low. And if you understand basic market structure, you should be able to identify highs and lows. And if you are not able to, well, that's why I told you about this indicator. It's going to point to you, right? It's going to show you where your highs and lows are. So this is the low that got swept. This low right here, right there, it got broken. So I'll indicate this with a sweep, and that is all an asterisk, right? It then went into the fair value gap, okay, and then it came above this side. So practically, okay, under normal circumstance, this is the high that we are going to use, right? This is the high that we are going to use. So right there, and so that high we indicate is as what? Our market structure shift, or our what? Our change of character. Or if you don't want to bother yourself with all these things, just call it a break of structure, right? This is not a real break of structure, by the way, right? This I might say a break of structure anyway, but this is a change of character or a market structure shift. But just call it break of structure so that you don't get confused, right? So what the price do here? It swept liquidity, or it broke a low into the low, a fair value gap, and then it rallied. You see the displacement. Now you can count the number of red candles here. 1, 2, 3. Let's start from the sweep. So we have 1, 2, 3, 4, 5, 6, 7, 8. And then let's count the white candles. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Well, it's more than 8, right? So practically you can actually see how fast price wanted to move. And what did it do? It first created a fair value gap right here. This indicated displacement. There was a fair value gap that was being created already, and even price tapped into it, right? Price tapped into that fair value gap already, right? Good. But because price hasn't broken market structure or shifted market structure, we can't trade from this fair value gap yet until market actually goes above the high that created the low before we can actually trade from that fair value gap. So the market did its thing here, right? Traded from the fair value gap. Now, I'll just say this so that in case anyone wants to learn further, they can actually come to me. When market creates something like this, this is a 15 minutes what? Fair value gap. So there's another entry in the 1 minute that you can use to enter from that 15-minute fair value for further confirmation. So this is not part of the classes. If anyone wants to learn, I'll teach it for free. Just contact me. Okay. Even if you learn this yourself, if you learn this 4 hours and 15 minutes, you can actually apply it when you get the time frame alignment right. So I can just give you the time frame alignment later after this video. So now, when price swept liquidity, went into the fair value gap, and then shifted market structure, as we can see here, with displacement actually, price never really came into any fair value gap here. There was a fair value gap that was already tapped into. Another second fair value gap is right there. That was already tapped into too. And as you can see, all these happened whilst the market hasn't actually shifted structure. So we can never really tell. We can never really tell that this fair value gap is going to work because it hasn't shifted market structure yet. Okay, so price never really came into it, and then it went to our target. That is the bold line right here. So now, in this case, even though you were right, you just missed an entry because price never came into your fair value gap. So if price had come into our fair value gap, what would we do? We would then use that fair value gap and then trade higher. Don't get sad that you missed an entry. There are multiple opportunities that would come around, and then it happened too. So price came around. Good. So now we have this low right here. Let's go into the file again for me to actually be able to identify where I'm at. So good. We have another fair value gap right here. And please, when you look at this structure right here, okay, when you look at this structure right here, this structure was a downtrend, was a clear downtrend. Price then went upwards and then ranged. So if you see from this level, you can't actually tell where price is moving towards. You can't actually tell if price is actually going higher or going lower. So I would advise you to not trade this in a range. Make sure the market is actually clear before you can actually do this. All right. So we would skip this fair value gap, even though the entry was actually presented. Let's get to fair value gap. I'll show you. The entry was actually presented. I just don't want us. I'm sorry. I have to delete this so you don't get confused. Good. So that is the fair value gap that was in the ranging market, right? This is the fair value gap that was in the ranging market. Price did what? Went to that fair value gap. And then it came lower. Let me show you something here. What I showed you was a textbook example. And I always say this: we have a textbook example and we have real examples too. So when you get into the market, now what you learned in the textbook is not what you see. Because now you'll be seeing real market conditions. Right. So this is the low that caused the retracement. We were in a downtrend. So price went lower and then went higher. Right. So this is the low that caused the retracement. This is our target. This low right here is our target. Now, when price was entering the fair value gap, you see it entered the fair value gap. Let me show you something right here. From the low right here, we have a high. We have another low. We have a high. We have another low. We have a high right here. That is why the indicator is right there. I'm not saying use indicator to trade, though. Don't go and use indicator to trade. But then this is actually a helpful indicator. So anyone that says they don't use indicator to trade, maybe they're talking about the RSIs and then the other ones, the 200 moving averages, right? Well, people use trade and they are profitable too. So you can't just condemn indicator traders. But then you see what this indicator did was that it pointed to you that this right here is a high because there's a red dot on it, and it's actually accurate too. So as you can see, there's a red dot on it, makes this a high, created this low right here, this little low right here, before price rallied into the fair value gap. The reason I'm showing these kind of examples is that the example that you'll be seeing, the ones that are actually not clear to you that is this the one that was in the textbook, because we show you too much that it's actually beautiful. Please, the price is not, the chart is not beautiful. Sometimes it will get you confused. Sometimes you see beautiful entries too. All right, let's continue. So when price entered the fair value gap, you see it created this high before entering the fair value gap. So now we expect price to come below it. So this high right there that was created. Okay, this high right that was created. This high right there. That is the high that got broken, and in the future we expect it to be a high that got swept. Now, if this is the high, then where is the low? The low is also right here. If this is the high, this is the low, right? This is the low of that candle. In ICT, we actually focus on individual candles. Okay. I'm very glad that I got this example because sometimes you wouldn't be seeing things pretty much clear. And then you might actually make a mistake. This is a high, right? Price went above that high, and then came below, okay, came below it right here. So we are in an uptrend, right? And then price tapped into the fair value gap. And then it changed market structure right here, right there, market structure shifts. So now we have our market structure shifts. Do you get it? And so we expect price to move into the fair value gap that was created in this displacement. So there is a fair value gap right here, a very little fair value gap that we were unfortunate enough price traded back into it already and then moved lower. But it's still a valid fair value gap. We have something called balanced price range, okay? And I don't think I have to teach this here. But then this is still a fair value gap, okay? This is a fair value gap that you see price respected it. Look at these candles right when you enter the fair value gap that was created during the market structure shift. Look at how they respected the fair value gap. Look at this fair value gap right here. This candle right here, right? Look at how when it went into the fair value gap, it created a wick and then did what? Came back in to make a body below it. That means the fair value gaps wants to be respected. It wants to push price lower. And so for that matter, since price hasn't seeked liquidity yet, so when I was starting, I was talking about if price is not offering fair value, it is seeking liquidity. So when price moved into that fair value gap right here, it has been mitigated. It means it has already what? Been used. But price hasn't seeked liquidity yet. And that liquidity is the low that was actually created that started the retracement. So we need price to do what? Come and then sweep this, use the fair value gap, and then go to that low. Okay, that low right here. And so when price went up, swept market structure shift, and then it went back into the fair value gap. So as you can see right here, with these candles too, look at how they are respecting the fair value gap too. Even though the fair value gap has already been mitigated, but then it hasn't completed its objective yet. So the price can't move without completing the objective. So then the price came back into it. And then look at how the candles respected the fair value gap too. Look at this candle, went into it and then came back to close outside. In fact, it actually went into it and even almost went above it and then came to close back. And then this next candle went into that same fair value gap again and it did what? Started falling. This in this shade, we call it it just started falling like raining water. And then it did what? It came into that low. Now, if you are greedy, okay, if you are greedy like some people, I'm not greedy though. This is where you enter. You enter in that fair value gap right here. Okay, you enter right here. You put your stop loss above the high after the sweep. So this high right here is where you put your stop loss. And then you target what? 1:2. Okay, target 1:2. So unfortunately, price actually couldn't get into the 1:2. But then the idea was completed. In this case, you are going to take a loss. Now you see, you actually got the trade idea right, but you still take a loss. You got the trade idea right, but if you were waiting for price to actually get into to that low, price got to that low later, but it was then later in the future in the price. So this is where goes when price gives you all your risk, okay, so let's say you risk 50%, $50, right? And when price gives you $50, that would be 1:1 hour. Just take the partials or lock the profit at 1 hour and then let the rest run. So when price comes back, okay, when price comes back, you already have a little profit, or you set break even, So this is the reality of trading. You actually got the idea right, everything was right, but you never reached your target. And so what did the price do? You hit a stop loss. This is the reality of trading. I'm not going to lie to you here that my strategy is 100% sure that when price gets to here to get, no, we won't do that here, because if you actually want to learn how to trade, you have to learn the realities of trading too. I'm not going to lie to you. Good. So I have explained the entry model here again. I have a few examples to that you actually reach your target to. Don't worry. This is one of the most beautiful ones that you would ever see. This specific entry right here. So you have the fair value gap here, right here, right? And then price created this high. This high right there. This high right here. This high there. So this high is what started the retracement, right? So you expect price to come back to that high. All right. Price went into that high. Okay, so price started the retracement and then came into that fair value gap right here. Okay. Now what did it do? Look at what it hit. Look at what it did here. Look, just what this. Watch this very, very carefully. Sorry if I've zoomed it too much. But you see, when this high was created, when this specific high was created, and price was coming back into it, you see how choppy price was. You see how choppy price was. It was like the market wasn't moving in any direction. But the moment it tapped into the fair value gap after creating this low right here, it created multiple lows. We have this first low, second low, and the third low. This is the third low. The third low is the one that we are using because it's the recent low, right? When price created this low and then went into the fair value gap, this low was what? Swept. This low was swept, and then price entered the fair value gap. Now, what do we see? What do we see here? A market structure shift right here. A market structure shift right here. Right there. Market structure shift. Low was swept into the fair value gap. Price then went above what? What do you see here? A high. Price went above it. Multiple fair value gaps here, right? So all these that you see here, they are kind of choppy prices, but above the market structure, you see that you have a fair value gap right here. Fair value gap. And look at how it's so much beautiful, because look at how it was respected. Price just came into that fair value gap and then rallied upwards like that. Now let me teach you something. Since the market structure shift, okay, happened right here, where there was no fair value gap, it means that you couldn't enter, and that means you're not doing what? Entering the market. Now this high right here was actually reached before price came back into the fair value gap. But since we know it's an uptrend already, what we are looking for is price to come into that fair value gap. If price seeks liquidity before offering fair value, when price comes to the fair value, it will also still offer fair value. It does one of those two things. It's either seeks liquidity or offer fair value. So if it seeks liquidity first before offering fair value, fine. If it seeks fair value before offering liquidity, fine. So price went to our target, right? The one that we used to be our target first, before actually coming to the fair value gap. It still came into the fair value gap, and then you enter right here at the tip of the fair value gap. You put your stop loss below this low right here, this swing low that swept the liquidity. That's where you put your stop loss, and then you are targeting 1:2. There's a reason I keep on saying 1:2, because that's the realistic one that you can do. You can do 1:3, 1:4, but it's the most realistic one. So 1:2, 1:2 right here. And then in a space of 30 minutes, you are done. In a space of 30 minutes, You are done. I've showed 3 examples. Now, in the first 2 examples, market wasn't clear. It still gave us our model, gave us our entry. Even if we entered and then one we got we were stopped at break even. Or if we took partials, fine. Now this is the example number 3, right? I'll show you the last 2 and then we are done. Okay. I'm just trying to prove to you that this entry model works. So when price came into the fair value gap after shifting market structure, created the fair value gap, price came into it and then did what? Please, when there are 2 fair value gaps, okay, when there are 2 fair value gaps, use the first fair value gap, okay. So something like this fair value gap right here, okay, this fair value gap right here. I will still advise you to use the first fair value gap because I don't want to add, what do you call it, premium and discount to these teachings. As I said, it's for the exclusive my mentorship, right? But then if you have the idea, you can actually add the premium and discount to it to actually better your trading if you have the idea. This fair value gap right here, so you can actually enter at the first fair value gap and make sure that you create room for this second fair value gap. So you enter from the first fair value gap and you create room. When I say create room, make sure that you allow room in such a way that when price comes back into that fair value gap, you won't be touched, right? When price comes back into that fair value gap, you won't be touched. Put your stop loss below this low right here, this low. Just put your stop loss slightly below it, and then target 1:2R. Right? Target 1:2R. It's just easy. Just follow the rules. And if you hit a stop loss, you know that you followed your rules. This is how I trade, by the way. Just simple. No inducements, no nothing. Just this simple 1, 2, 3. Market structure shift, sweep, fair value gap, enter. Market structure shift, sweep, fair value gap, enter. That's it. So 1:2 and then you are done. Another example. Good. You run another example here, another example right here. So most of the examples that I've been showing, price has been creating the lows or the highs prior to the fair value gap. Now, in this example, we have price actually creating the high inside the fair value gap that actually got swept. So price created this low right here. You see this high right here? That was first created. Price went above it. Now, since price never came below it, it's a break of structure rather. And then price went into the fair value gap and then created a high inside the fair value gap, and then it got swept again. So what do you see here again? Basic market structure. Have a high, right? A low, a high right here. What? A low right here, a high. So that means this is the low that we are waiting for it to shift what? Market structure. This low right here. And on that, yeah, chain. That's what we are waiting for it to shift market structure. If you don't understand, I'm sorry. So this high right there got swept. Price went above that high. Then it came below it. Right there. So when it came below it, that it's called market structure shift rate displacement. So the displacement is what's giving you the fair value gap. Rate displacement. So we have the fair value gap inside it right there. Fair value gap, right? Now in this one, we have 2 fair value gaps. Another one here too. 2 fair value gaps. It doesn't matter where you want to enter from. If you want a good risk reward ratio, you can decide to enter from this first fair value gap. Okay, so you can decide to enter from this first fair value gap, right? Or this second fair value gap. So now you enter, right? When you see the sweep, the market structure shift, your fair value gap with displacement. The displacement means the price was moving what? Faster. So these are strong candles. You enter right from here. Okay. Where is your stop loss? Below, above this high. That's swept liquidity above this high. That swept liquidity. Good. How much are you targeting? 1:2. 1:2. Yo, 1:2. Let's go. So 1:2 is somewhere here. 1:1.9. So 1:2 right there. So let's zoom out and then good. You see, so sometimes it will take quite long for price to deliver. Sometimes it take a while. Sometimes price won't deliver. These are the raw market conditions. But you see, I've shown 4 examples right now, and with all those 4 examples, we had one that our entry was presented, but we couldn't enter because it wasn't really clear. We had another one that entry was presented, we entered, but then we hit stop loss, break even, or we took partials. We had another one that we actually got profit, and we had another one right here that actually got profit. So the model is always present, like it's always there. It is always there. Let me go over it one last time. And then I don't know, maybe I'll use EOUSD to explain another example, and then we are done. Sweep into a fair value gap, either prior to it or inside it. A 4-hour fair value gap, 15-minute sweep into a fair value gap. A market structure shift. A fair value gap in the market structure shift. A fair value gap in the market structure shift. Price comes into the fair value gap. You enter from the fair value gap. So if you have 2 fair value gaps, you either enter from the first one or the second one. You could wait for the second one, and price might never get there, so you miss the entry. But if you wait for the first one, you will be able to enter. It's just that you will not have a good risk reward ratio as compared to the one that would enter from the fair value gap. That is, upper right there. Price went to the fair value gap. Your stop loss above that high right here. Above that high, that's your liquidity. That's your stop loss. And then you are targeting 1:2, or your target, that is that low that caused the retracement. Okay, this low right here. This could be your target first. So when price gets to that low and you think price could actually go more than that, you just take your partials or you break even. Then you let the rest run. All right. So good. So I made this example right here too, and I want to teach you guys something. You see, we are in a downtrend, right? And this was a first value gap that was presented. Price went to the fair value gap. We looked for our entry model inside it and worked, right? So let's say you mark this fair value gap too. So we're expecting this fair value gap to hold too, right? But then when price got there, it actually broke through it. It didn't actually push price lower. What does this mean? Okay, this means that your entry was not presented. So when you go into the 15 minutes time frame, you will see that there was never a sweep, a market structure. There was nothing there. You see, this is the fair value gap, right? When you go into the 15 minutes, so this has got to do with entries, confirmations. If you don't have a confirmation, don't enter. Now, this is the example. This is a low. This is the low that created the retracement, right? And then before price was entering, or when price entered the fair value gap, it created this high right here, right there, right? Created this high, and price never came below this low. Price never came here. Do you see? And then when price went up, and then it even went above that fair value gap. It means that, bro, we don't have a trade. We don't force it. Okay, we don't force it. And then when you look at the markets, right? This, when you trade, like, let's say even two pairs or 3 pairs, every week you are going to get 1 or 2 trades. And when I was first learning this, ICT told me that you get 1 or 2 trades every week. And I was like, the whole week, 5 days more, I only have 2 trades. I was so naive. I was like, bro, 2 trades, just 2 trades. So later I realized that sometimes you would even be fighting for just half trade, not one, half, because there's nothing on the market. And you see, when you have a good win rate, That is the good thing, not how many trades you've taken, a good win rate. So if you even take one trade in a week, that is a good trade. You've won for the week and you are done. So next week, just come and look for it. It's about compiling, right? It's about compiling, not trying to force anything. Don't force it. You see, in this market, when you force things, you will regret. So when there's no trade, there's no trade. That's why I gave you the 4-hour fair value gap, and I gave you a 15 minutes model, right? A 15 minutes model for you to trade it. So if you don't see your model, you don't trade it. If you see your model, you take it with confidence. If you hit stop loss, you know that you followed something that works, but it was just a bad day for you. Or you just let it go. Okay, when you see it, just take it with confidence. And so I'll be done soon. I think I just have a few minutes left, and then I'll be done. Right? What I want to say is that in my 6 years of experience, I don't have money to actually show you. I don't have money. If someone has 6 years of experience, sorry, Atipo said this is 7th year. He's lying. It's actually going for 8 years rather, and I think either 8 or 9. Atipo is like very rich. Atipo has 7 years of trading like experience, or 8 years, even 7 years, right? And I have 6 years. I have less money to show you, though I have made profits from trading, but then I have less money to show you to actually prove that I'm actually a 6 years trader. Misika Andrew $50,000. I've traded for 6 years. Andrew. So what's the advice I want to give you? I want to give you an advice. The advice I want to give you is that after learning all these, you need to focus on your psychology. Read books about psychology. Understand how your brain works. Understand how your body works. Understand your greed. Understand your greed level. Understand your confidence level. Because when I teach you something like this, right? 4-hour fair value gap, 15 minutes entry. When I teach you something like this, and then you see it for the first time and you take it and you hit a stop loss, your confidence is going to be shattered. Because the first time that you saw it and you took it, it didn't work for you. Your confidence is going to be doing what's shattered. And so that means that you will never be confident in taking those same trades again when they present themselves. Meanwhile, they are actually the profitable ones. But because you first hit a stop loss, you never wanted to trade them again. Meanwhile, they work. So this is the mistake that I did. I was never confident in my trades. Never. I was never confident. So I would urge everyone, please, after learning the technical analysis, after learning the entry models, please and please again, focus on the psychology part. Because whether you like it or yes, trading is full 90% psychology, even 99% psychology. Because this technical analysis that I'm showing you, that you strive so hard to learn, it doesn't work without psychology. It doesn't work without a sound mind. It doesn't work without someone who is not greedy. It doesn't work. This last example, and then we move. All right. So this is our external range liquidity. This is the low that created the retracement. We're in a downtrend, right? This is the low that created the retracement. So that's our target, right? Good. Price did what here? What price did here? Is create this high into the fair value gap. Inside the fair value gap, actually, created this high. So it got swept, right? And then what did it do? It changed market structure right there. Right here. Change market structure. Or shifted market structure. Okay. And then multiple fair value gaps were created. Have a first fair value gap right here. Right. We have another second fair value gap right here. And so what the price do first? Price first entered into this fair value gap right here. So when price shifted market structure right there, okay, when the market structure was shifted right here, price then later created the fair value gaps with the displacement. So you see how strong these candles are. That's what I want you to look for. Look for strong candles, displacement candles, the one that actually indicate that price wants to go lower. Price came into this fair value gap. So we first enter from this fair value gap, right? And where do you put our stop loss? Above the high, that's your liquidity. Or in case you think this is too far and then your stop loss is too exposed, can place it above this high too, because there's no fair value gap above it again for price to actually go into it, right? And then you target what? 1:2 hour. So you target 1:2 hour. Good. Just target double of your risk. Good. And then price delivered, right? So price delivered nicely. Now, if someone wants to actually enter from the second fair value gap, that means they would have to wait for retracement too. So this retracement, this is how you manage a trade like this. There was a first fair value gap that you entered from. Now there's another second fair value gap above your fair value gap that you entered from. And then when price is trading towards that fair value gap, you are so worried that price is going to hit your stop loss. Meanwhile, there's a fair value gap there that also has to be filled too. Then you'll be so worried, then you'll be closing your trade because price has come to your entry after giving you what? Almost TP. Price came to your entry. So you are so worried. Bro, relax. The market will do what the market will do. Just let the market do what the market will do and do what you will do, and then let the market do what it will do. Okay. So price then came into this second fair value gap right here. And so anyone that makes this first entry right here, we'll just be waiting for price to come here. And when price comes to that fair value gap, you just target your 1:2 hour. And even that one is even sweeter because when you enter from there with that same stop loss, you have 3 hour rather. And even if you put your stop loss above this high, right, you still have your 2 hour because this is the one that caused the retracement too. Do you understand? Again, another last example. What did price do here? Price swept this high and then went into what? The 4 hour fair value gap right there. Price swept the high, went to that 4 hour fair value gap. And then what did price do again? It shifted market structure right there. Market structure shifts right here. And then it delivered lower. Now, before I actually show you if market delivered lower, look at something that happened right here. With some things like this, and you will fear purely will fear for. Because, bro, how come the market delivered so beautifully like this? It went downwards, but then, because you enter from this fair value gap right here. Let's say this is the fair value gap that you wanted to enter from, right? Good. And then before the market structure shift, when price shifted market structure, and it came back into that fair value gap that was already mitigated, price came into it again, right? Then went and then actually swept this high right here. So you place your stop loss there. That is where this one I can't do anything about it for you. I have no idea. If you are my student and you bring this to me, in fact, I will take this trade and I will take stop loss too, because I'll also put my stop loss right here. And look at how funny it is. Everything was delivered. That's why we advise you that anytime you are placing a stop loss, just give it space to breathe. If you are giving it little space to breathe, bro, you would make a lot of money. But since you didn't give it the space to breathe and then you just put it right above it, like that's what I will do too, because I want tight stop loss that will give you more risk reward ratio. I'll just put it here, and then unfortunately everything was presented. The sweep was presented, the market structure was presented, fair value gap was presented, but still we had a stop loss. This is not because you were wrong. Don't go and cry. Don't go and get depressed. Don't go and cut yourself. This is because the market was purely manipulated and you had nothing to do with it. Because it just went to the tick. Bro, just to the tick of it. And then was like, what the hell? I'm not making you money today. Then it came down. You would cry. So this is a simple entry model that I wanted to teach you guys. And then I think I'm done for today. Yeah. So market structure shifts, right? First thing I'm looking for is a fair value gap from the 4 hour time frame in the right structure, so a downtrend or an uptrend. I'm looking for a fair value gap, and in that fair value gap, when price gets to that fair value gap, you go into your 15 minutes time frame, and in the 15 minutes time frame, you are looking for number one. So if you noted everything down, number one, we're looking for a sweep, either prior to the fair value gap or inside the fair value gap. Okay, and then when the sweeps happen, we're looking for a market structure shift. So the moment price goes above a high in that value gap or price to that value gap, you just mark the low that created that high, waiting for price to go below. The moment price goes below it or goes above it, we have our market structure shift. And then within that shift, we are looking for a fair value gap. Okay, we are looking for a fair value gap. And then when price gets into that fair value gap, I want you to take it with confidence because I know what I'm talking about. This is how I trade. Take it with confidence, bro. If you even hesitate one bit, price will move away and then you might actually go to your target and you would regret not entering. Just do it anyways. And honestly, nobody knows what the price will do. We are just working with probabilities here. So you don't know what in the market will just do it. Okay. This is just a lesson on psychology. Just do it. Do it and then let the market do what it will do rest. Because after all, nobody knows what the market is doing. Even the market makers, they take losses too. So if you have probabilities in your side, if you have the odds in your side, why are you hesitating? Why are you second guessing that it is going to go for me? No, you don't have to guess because bro, you don't know, honestly. You don't know. You just have the probabilities in your side. Just do it anyways. And then I hope that this boot camp helps you to actually be a good trader. You learn more for yourselves too. Anything that I stated here, you can actually go onto YouTube, then you learn from other channels to gain more knowledge on what I said. But you will not find this specific idea there because this is just how I trade for myself. Combination of the model and the fair value gap. But then you get the model and the fair value gap too. You just not get the combination, you not get it though. But then if anyone wants to talk to me too, you can contact my brother, right? He's going to give you my contact. You can actually talk. I can actually mentor you for free because of this boot camp. I'll have time for you. I'll make sure that you understand the market how I want you to understand. Thank you very much for having me. And I'm really happy that I was able to